Good day, traders. Welcome to another video on the basics of institutional trading. This course we designed for the beginners who want to understand how institutions trade. So if you have missed our previous videos, please go to the playlist and you will find on our channel the part 1, part 2, part 3 of those videos. This is the 4th video in a series. Initially, we planned for the 5 videos, but looks like we need to do at least about 7 or 8 videos. Today, we will learn liquidity, which is an important part of the institutional trading. If you master the liquidity, you will reduce your losses or your losing trades significantly. Okay, so out of the way with those early introduction, now let's move to our presentation. Before we do this one, as usual, the disclaimer as required by the regulators. This video is presented only for educational purpose, and it is not a recommendation of buy or sell at any time at all. Note this is a financial advice. Please respect copyright of the K5 Trading, and the content in this video are copyright of the K5 Trading. If you like our analysis and if you like our institutional trading concept, which what we are presenting, you can join our Discord server where we regularly provide an updates and the trade setups for the ASX, PSX, US stock, New York Stock, the Indian Stock Exchange, Forex, cryptos, and the commodities. The joining is free. It's free to join. tinyurl.com/K5 Trading, which is a shortened URL so people can remember, or you can scan the QR code. And please subscribe to our channel, youtube.com/K5 Trading, and press the bell icon so you can get the timely videos whenever we post it. You can also join, like our Facebook page, K5 Trading, and join us on the Telegram, t.me/Telegram. Sorry, K5 Trading. This is, as I said, this is the 4th video. The first video we did was a single candlestick pattern, how the institutions actually see a single candlestick, and the market structure part 1, part 2. Now, today we are talking about the liquidity, which is this module, and we will have 2-3 more modules for the other things as well, like point of interest and the developments of the trade setup. Before we continue with the liquidity, I like to present a concept called premium and the discounted zone. Premium and discounted zone is very, very simple concept. When you have an external leg, or you have an internal leg, or you have a single candlestick, when you divided that by the 50%, so above the 50% is your premium zone, and below the 50% is your discounted zone. The concept is that if the institutions wanted to buy some assets, or they want to add the positions, additional position on their asset, they will always buy at the discounted zone. If they want to dispose of some assets, or if they want to go short on someone, then they will always try to dispose of all the short from the premium zone. So this is the very, very basic concept. So if you only just follow this concept, I can guarantee you that the many of the trade you will, which you actually initiate at the premium zone, they will stop and you will start making money. Yes, the number of the trade will be reduced. But that's what it should be with the money management. You don't want to do every single trade. Now, this was the basic concept. Also, when I say this is a single candlestick, that means that's the upper wick is actually the liquidity and buy side liquidity, and the lower wick is your sell side liquidity. The reason why is liquidity is here because wherever you see a lots of efficiency in the pricing, that means you got pending order below here and the pending orders above here. This can be stop loss, they can be stop order or whatever, and the institutions actually try to chase those markets. So if an institution like to go long on this particular day, they will always come down, try to grab this liquidity, and then they actually push upside in the market. When they actually initiate their position, they buy some and open their position, and then they will try to bring the market at the upside, and then they try to grab this liquidity at the top. So for example, today, if you got your market is a bullish market, and the market is actually going to start from here, because that's your bullish market is a closing here, and the next day, if the institutions want to go long, they have a two option. Number one, they will either go from here onwards, right upside, or they will actually come down a little bit in the middle and try to find their position somewhere around a discounted zone to go for the for the rally of the market. So this is always very, very important. Remember the discounted zone and the premium zones. We need to make sure we understand that. Now, what is the liquidity? As I just mentioned briefly in the other slide, the liquidity is the zone where retail traders place their order, stop loss, take profit in the anticipation of a particular pattern or the area. Liquidity is also a zone where institutes also place their order in anticipation of the attracting the retail trader. This is called the engineered liquidity. And engineered liquidity, and the liquidity is also a zone where banks and commercial entities place their large order to meet their foreign exchange requirement. So every banks, commercial banks and the big banks, they have some requirement. They have to convert some foreign exchange from one currency to the other currency, and they actually just look for those zones where they can actually get the best deal for their client or best deal for their bank, and those areas also create liquidity. There are two types of liquidities. We will only cover visible liquidity. Hidden liquidity we will cover some other times. So visible liquidity is equal highs, what we call double top, equal lows, what we call the double bottom. Previous day's high, previous day's lows, session high, session low, weekly high, weekly low, previous week highs and lows, climactic action. This is from Wyckoff schematic. So wherever you see the selling climax or the buying climax, you will always find some liquidity above or the below of that area. And when you see any spring and the upthrust, they are actually sweeping those liquidities at the climactic action and then going market in a direction where it's supposed to go. A trend line liquidity, support and resistance liquidity, and swing highs and swing lows. So let's start drawing those concepts on the chart so you can understand. So first of all, what is equal high? So market went up, come down, gone up, and let's create an equal high up here when it's come down. So what's happened, that's people who, the retail trader basically see this pattern and they think double top. So they place their order, their stop loss are somewhere around here. So the institutions, they bring the market down to attract those retail traders, to have them thinking this market just really want to go down, but it doesn't go very far and then come back, sweep all those liquidities and then goes into the original direction. So that's the double top. And if you look at for the double bottom, it's simply the reversal of that pattern. So you got this W pattern where you got double bottom, and then the people buy from here, they got their stop losses and there's some pending order, whatever, and then market doesn't go too far, come back, take this liquidity and then move in the original direction. So that's what is the double bottom and double top liquidity we call. Previous days highs and lows. So if a candles, for example, we have a candle up here, and you have some kind of wick up here and wick up here. So the institutions, they normally see that's those wicks area where they see a buy side liquidity, and this lower wick they see as a sell side liquidity. So there are some pending orders here, and there are some pending orders here. So this is also considered a visible liquidity zones. Session high and session low, like Asian session high, Asian session lows, weekly high, weekly lows, previous week highs and lows, and all those kind of things. The climactic action, the only thing which I like to explain to you, everything else I think is pretty much simple. So what's happened? Market is actually moving up in a up direction, and then it's reached a climactic action with a high volume activity right up here in the bottom with that bar, and then market actually come down. When the market come down, we normally draw a resistance line here. Market try to go back in this zone, and then suddenly it's all whatever the liquidities actually have built here, it's take those liquidities, and that's we got an upthrust, and then market come down. So this is the climactic action, and this is the upthrust. So this upthrust basically take out the liquidity above this climactic action. So always remember, when you see a climactic action, and when you see the first reaction, which is automatic reaction, you just simply draw those kind of a box up around those areas, and see when the market actually try to take the liquidity above or below. So if it is a climatic action, definitely it will take the liquidity above first and then it will come down. Sometimes it also can happen that without taking this liquidity up, it can come, it's take those lower liquidity and then can go up and take the other liquidity. I normally don't trade those one. I only trade this setup where you got equal high up here and you got this liquidity and then it's a sweep of the liquidity. What's actually happened? This is your buying climax and this is your secondary test. So your buying climax with the high volume, secondary test is try to test as are there any buyer left, and then after that this upthrust actually sweep all those liquidities, all those short orders, people who have actually shorting around here. So it's take all those orders and then come back into the initial original direction. The similar things happen when the market is coming down. So for example, this market is coming down and that's come down, and then we got automatic rally, and then market try to make this low. So we just draw the line and then market try to move up, and then we got a spring, take out all those liquidity, selling climax, testing of the sellers, and then there is no seller left here. So market try to move up with the pending orders and stop losses below here. This spring comes, sweep everything, and then goes in the original direction, right? So this is the buying climax and the selling climax. Trend line is always very, very simple. Whenever you see those channels, you will find some liquidities here and you will find some liquidities below of those trend line. Market will try to sweep those trend line, and then it will try to take those liquidities and then goes in original direction. So support and resistance is also the same, and the swing high, swing lows. So for example, this low and this high, they have a liquidity on top of here. So one thing needs to remember always, market always chase the liquidity. If the top side liquidity or buy side liquidity has been taken out, then the market will try to go to take out the sell side liquidity. So always try to find out which liquidity has been taken. And if the top side liquidity or the buy side liquidity has been taken, try to find your entries for the short trade. This is the main concept about the liquidity. Now, what is an engineered liquidity after this? So the pullback after the extreme is a kind of an hidden liquidity. For example, the market is actually gone up. This is a buying climax. Then it's come down, and then it's tried to go up. And this is your hidden liquidity up here. So this is, if from Elliott wave point of view, this is A, B, C. And the C wave is actually taking the liquidity out of the A wave. And after the C wave, when the market push upside, it's take out the liquidity of this P. So this is still your resistance area. So that's your hidden liquidity. This is called the engineered liquidity. And always you can see this, there is also hidden liquidity below the elongated wick, whether it's up wick or it's a down wick. But if it's a elongated wick, you will always try and find some liquidity. Now, what is the difference between the BOS and the liquidity? Break of the structure and the liquidity is the thing where people actually get confused. Liquidity often sweep the previous swing area or liquidity area by the wick. BOS is always swept by the body. So for example, we will go to the example shortly. So for example, if this is your area up here, this high is actually taken out by some wick here, then we consider this area is a liquidity sweep. It's not a break of the structure. That's what I mean. Now, always try to remember those patterns. You will also find many types of liquidities with the retail trading pattern, like head and shoulder pattern. So with the head and shoulder pattern, how does this happen? Let's see. So market moving up, coming down, wave 4, wave 5, A, B, and C. So that's your kind of neckline. I think I just don't just too much here. So that's your neckline up here. So your wave 3, wave 4, wave 5, A, B, C. And the liquidity, what you got up here around this area. So this area is always have some liquidities which actually taken, and you will find sometime the fair value gap in those areas where you will find your entry point. So I normally wait for market to take this liquidity out. I like to wait for the market to take this liquidity out, or at least this trend line. We should have a point of interest somewhere around here. And I like market to actually retest this point of interest, and then I want to go down. So the head and shoulder pattern, they always have a liquidity around the neckline, and also like those the shoulders area. So watch out for those shoulders. Maybe it's not coming straight away, take it, but after some time, definitely it will take out this liquidity, all those liquidity, because these are now trend lines, right? All right, so after that, let me clean my chart. And now we would like to go to the charts and try to find out those liquidities. So we start with the double top. Right, so this is, I got AUD USD charts open in front of me. And let's see the trend line liquidity I can see here. So this is a kind of your trend line up here. And this is your trend line going up there, right? So look at what's happened. So market, with this low right up here, all this liquidity has been taken. Then market actually flash upside and flush out all those liquidities. So that's why this trend line liquidities, that's how it has been normally taken. So that's the example of the trend line liquidity. Now let's try to find double top somewhere here. Here is a kind of a double top. Right. Now that's area of the double top, right? Oh my, what's this happening? What is this? Hang on. Okay, so this is your kind of a double top area. All those candles, you see how the market come down, and then it was sweep with this area, then it's come down, and then again it's a break of the structure, and then it keeps sweeping here. Here is another example of the double top. So market come down, it didn't actually retest this area, but look at here, what's happened. This area is break this zone up here, and then it's come down and then try to retest. Here is another one, equal lows, equal highs. Market come down, and then it's with those liquidities. So these are the double top. Let me try to find some double bottom. So this is the area of the double bottom. Market went up, and then it took the liquidity. It's a little bit further away, but ultimately it stayed it. Okay, so this is another example of the double top. So you see those double top, market come down slightly, and then it's gone in the opposite direction. So these are the liquidity sweeps examples for the double top and double bottom. Let me go to the lower time frame, see if I can get a few more examples with the double bottoms. All right. Again, this is a trend line liquidity. You can see this trend line, and it's broke there. Here we got the double bottom area, right? So market move upside, and then it's suddenly coming down after this liquidity, and then it's coming down. So you can see this area all up here. This is the liquidity zone, right? All those liquidities is taken out by this move, right? Coming down here, right? And this move up here, it's take out those liquidities. So always look for those liquidities areas. Everywhere you will find it. Now, what else we got on this liquidity zone? So what else you want to find is break of the structure we did cover. Double top, double bottom we covered. And now let's have a look some elongated wick liquidities. So for example, this area. Did you see something here? This zone up here, right up here. Right, I was expecting that there should have some kind of liquidity, and those liquidity must be swept. So this wick up here, okay, what's happened? Market come down, retesting this area, taken out all those orders, come down, and then it's gone into the original direction, like it's coming down and then gone up, right? So it's not a good example, but I just want to show how the liquidity works. So for example, here, this is another example of high liquidity zone. So here you got the zones. So market hasn't taken this area just yet, but it will taken out this area sometime in the future, because there are some pending orders sitting here. This double top as well, and this high liquidity is not right now, but it will sooner or later, this zone will be actually retest and break out this, then the zone will be break out just to take those liquidities out. Let's go into the future, some past examples so we can see it clearly. Okay, so this is the another example, as you can see, and it's taken out, not yet, so it will happen sooner or later. Okay, so this is another one, liquidity area, market taken out. This area, high liquidity zones. So we need to try to actually get your eyes on those liquidity zones. Once you get mastered on the liquidity zone, then it will make your life a lot easier. So that's what I had for the liquidity. Now I'd like to introduce one of my scanner and our tool which we have developed for MT4, and soon we will develop into the MT5 as well. So the zone or the scanner is something like this, and this will actually just show you those point of interest based on the institutional trading, and that's showing us like how many points away market from those zones, so we can get it ready. So I'll give you an example for Australian dollar and JPY on the M5. So if I can go back here and go to the AUD JPY, and here I want to go for M5. And I probably don't have any indicator, so let me draw my indicator so I can simply see if it can pick up. Okay, so oh my god, it's picked up so many things on the 5 minutes time frame. And where is my zone? So zone is somewhere around here, right? So let me disable a few things because they're not needed. So for example, I don't need DTM at the moment. I don't need any point of interest, 500 bar, yeah, that should be fine. Okay, so, and this is the zone, this is the area of the session basically. So that's not the zone, this is the sessions. And let's try to work out where it is actually drawn this zone. So for example, it says 93.764. So let's go back here. I will just simply draw this line, 93.064. Okay, it's quite low. Okay. It's somewhere around here, sorry. 93, I just need to see it again. 93.764. $93.764. That's the zone, right? How does it define that zone? It's basically seeing that this is the zone it's actually defined, right up here, and the market is currently here. So the zone which I'm looking is this one. That's the zone. Market is already touched here once. So this zone is become invalid, right? So I wouldn't actually buy this zone now, even though it says the price is currently about 73 pips away, but this zone is already touched. It would have generated a signal when about maybe about an hour ago, it would have generated, or half an hour ago, it would have generated the signal for this long trade. So how many, normally we have an stop loss here and an entry here. So it's already 9 pip trade. It's still going up. So, and the stop loss was only 4 pips. So 8, 9, yeah, it's 1-to-2 ratio. The market will continue to go up. So that's how we actually pick up those scanner. Unfortunately, our indicator is a little bit lagging and it doesn't draw the channel accordingly right now. So we are going to fix very soon this one, but this is what it is. Now you can see AUD JPY has also got on M15 chart as well as 93277. So if you go to the M15 And this is the zone I think is talking about 93277. Yeah, so this is the zone 600 pips away. It's drawn up zone very correctly here, but it's not on M50, on M5. Yeah, it's about 600 points. So that's the zone was already developed, but it hasn't drawn this one because the zone actually was drawn here previously, but because it's taken out, so that's why it's not showing anymore. All right, guys. So that was the session. We're going to release this scanner very soon with the public, and you can use for this the smart money concept or the institutional trading concept here, the day trading model, which we will explain in some other videos, and also our metric system, which we will also explain in some other times. So until we can come back to that, enjoy the trading, and good luck, and see you again in the next video. Bye now.